Why senior analysts are now projecting $7,000 to $10,000 gold, and what it means for you. The same institutions that laughed at $2,000 gold are now quietly revising their numbers, not to $3,000, not to $5,000, to $7,000, $8,000, possibly $10,000 per ounce. And here is what they are not telling you, why they revised those numbers, and when they expect it to happen. That answer changes everything. Welcome to Metal and Macro, the channel where the numbers do the talking and the patterns tell the truth. Now, before we go any further, if you have found your way to this channel today, there's a good chance you're the kind of person who reads between the lines, who asks the questions others walk past. So let me ask you something. You would not leave the house without locking the front door, would you? Think of that subscribe button. The same way. Just a small, simple action that protects what matters. Press it, it takes 1 second, and you will never miss what comes next. And while you are here, drop a comment below. Tell us, where in the world are you watching from today? Whether you are in Lahore or London, Dubai or Delhi, New York or Nairobi, we want to know who is in the room, because the people watching this channel are not ordinary. Now, let us begin. There is a particular kind of silence that falls over a room when someone who was once laughed at turns out to be right. It is not a comfortable silence. It is the silence of people recalculating, reassessing, quietly wondering how they missed it. That silence is happening right now in the boardrooms of the world's most powerful financial institutions. And what triggered it is gold. 2 years ago, if a financial analyst stood in front of a camera and said that gold would reach $5,000 per ounce, he would have been dismissed before he finished his sentence. The mainstream financial media had a name for people like that. They called them gold bugs, doomsday preppers, people who did not understand modern markets. Those same voices are quiet now, because gold did not just reach $5,000. It surpassed it. It climbed to an all-time high of $5,195 per ounce on January 29th, 2026. And in the single year of 2025, it delivered a 64% return. Not in a hypothetical scenario, not in a textbook example, in the real world, last year. But here is where the story becomes truly important, because the question that serious decision makers are now asking is not, how did gold get here? The question they're asking is, where does it go next? And the answers coming from the world's most respected senior analysts are numbers that most people are not yet prepared to hear. JP Morgan, one of the most powerful financial institutions on the planet, is now formally forecasting gold at $5,000 per ounce by the fourth quarter of 2026. And in the same breath, their analysts have stated that $6,000 is a real possibility beyond that. UBS, the Swiss banking giant whose clients represent some of the wealthiest individuals and institutions in the world, has set a target of $5,400 for 2026. Goldman Sachs, whose research divisions employ some of the most analytically rigorous minds in global finance, is projecting $5,000 by 2027. And Bank of America has stated that, in an extreme but not impossible scenario, gold reaches $8,000 in 2027. These are not bloggers. These are not YouTube channels. These are not gold dealers trying to sell something. These are the actual institutions that move global capital. And they are all pointing in the same direction. Now, there is something critically important to understand about institutional forecasts. Banks and sovereign financial institutions do not publish price targets lightly. Their research notes carry legal weight. Their analysts are accountable to compliance departments, to regulators, and to clients whose portfolios are measured in billions. When an institution like JP Morgan or Goldman Sachs puts a number on paper, that number represents the conclusion of hundreds of hours of data modeling, historical analysis, and risk assessment. So when multiple competing institutions that do not coordinate with each other, institutions that in many cases are direct competitors, all begin converging on the same directional conclusion, that convergence itself becomes the signal. And right now, the signal is louder than it has been in decades. But there's a layer beneath the forecasts that most observers are missing entirely. The senior analysts projecting $7,000 to $10,000 gold are not simply extrapolating a price trend. They are reading something deeper. They are reading a pattern, a structural pattern that has appeared in the historical record before. Every single time the world's dominant monetary system has entered a period of fundamental stress. That pattern does not care about politics. It does not care about which party is in power or which central banker is giving the next speech. It operates according to its own logic, quietly, systematically, and with a precision that only becomes obvious in hindsight. The institutions that spotted this pattern early are already positioned. The sovereign governments that understood it years ago have been accumulating gold at a pace the world has not seen since the 1970s. And the entrepreneurs and serious capital allocators who recognize what is happening right now still have a window, but that window is not staying open forever. There's a rule that history follows without exception. Not a theory, not an opinion. A rule. Every single monetary system that has ever existed, everyone has gone through the same 4 stages, in the same order, without a single deviation in recorded human history. And the most uncomfortable truth about that rule is that the world is inside it right now. To understand where gold is going, one must first understand where money has been. Consider a simple but profound observation. In 1971, the United States government made a decision that changed the financial architecture of the entire planet. President Richard Nixon closed what was known as the gold window. What that meant in practical terms was this: the US dollar, which had until that moment been legally redeemable for a fixed quantity of gold, was suddenly backed by nothing but the promise of the US government itself. At the time, mainstream economists celebrated this move. They called it modern monetary flexibility. They said it would allow governments to manage economies more effectively. They said the old gold standard was a relic of a less sophisticated era. What they did not say, or perhaps did not see, was that this decision would set in motion a sequence of events that has been unfolding slowly, quietly, and with mathematical precision ever since. Because the moment a monetary system untethers itself from a hard asset anchor, the 4-stage pattern begins. Stage 1 is expansion. With no gold constraint limiting how much currency can be created, governments and central banks begin producing money at a pace that was previously impossible. Economies grow, markets rise, credit becomes cheap and abundant. On the surface, everything looks healthy, prosperous even. And for a generation or two, it genuinely is. This is the stage that feels permanent. That is precisely what makes it dangerous. Stage 2 is erosion. The excess currency that was created during the expansion phase does not disappear. It circulates, it multiplies through the banking system, and slowly, the purchasing power of that currency begins to decline. Not dramatically at first, not in a way that triggers alarm, but consistently, year after year, decade after decade. A dollar that bought a man a full meal in 1971 cannot buy him a cup of coffee today. That is not an accident. That is stage 2 performing exactly as the pattern predicts. During this stage, most people do not recognize what is happening because the process is gradual, but institutions do, and quietly, the most sophisticated ones begin to reposition. Stage 3 is flight. This is where the pattern accelerates, and this is the stage the world is currently in. When enough institutional capital recognizes that the currency holding their wealth is structurally weakening, they begin moving that wealth into assets that cannot be printed, assets that no government can create with a keystroke. Assets with a 5,000-year track record of preserving value across collapsing empires, failed currencies, and broken monetary systems. They move into gold. The evidence of this movement is not speculative. It is documented and publicly verifiable. In 2023, central banks around the world purchased more gold than in any year since 1967. In 2024, that pace accelerated. China has been adding to its gold reserves for 18 consecutive months. Poland, India, Turkey, and multiple Gulf sovereign wealth funds have all dramatically increased their gold allocations. These are not emotional decisions. These are calculated, strategic, institutional responses to a pattern that serious analysts have studied and recognized. Stage 4 is repricing. This is the stage that has not yet arrived. But it is the stage that every preceding stage has been building toward. When the market fully absorbs the reality of what has been happening, when the gap between the currency's perceived value and its actual purchasing power becomes impossible to ignore, gold does not gradually rise, it reprices, sharply, structurally, and permanently. It happened in 1934 when Roosevelt revalued gold from $20 to $35 per ounce overnight. It happened in the 1970s when gold rose from $35 to $850 in less than a decade. And every serious analyst who has studied this pattern knows it is not a question of if stage 4 arrives, it is only a question of when. There's a difference between a fire that is spreading and a fire that has just reached the fuel line. The first can be managed, contained, slowed down with the right intervention at the right moment. The second cannot. What senior analysts are now recognizing, what the projections of $7,000 to $10,000 are actually reflecting, is not simply that the pattern is continuing. It is that the pattern has reached the fuel line, and the timeline is compressing in ways that have no historical precedent. To understand why the speed of this cycle is different from anything recorded before, one must examine 3 specific forces that are operating simultaneously, not independently, simultaneously, because it is the combination of all 3, arriving at the same moment in history, That is creating a compression effect the world's monetary system has never had to absorb before. The first force is technological. For most of financial history, capital moved slowly, information traveled slowly. A sovereign government's decision to shift its reserve strategy took months to implement and years to become visible in market data. An institutional investor repositioning a large portfolio required weeks of careful execution to avoid disrupting the markets they were moving through. That world no longer exists. Today, algorithmic trading systems process more data in a single second than an entire research department could analyze in a month. AI-driven capital allocation models are scanning every central bank report, every sovereign reserve disclosure, every commodity flow, and every currency movement in real time. And when those models detect the pattern, they do not wait for a committee meeting. They do not wait for a quarterly review. They act immediately at scale. This is precisely why AI pricing models are now projecting figures like $10,427 per ounce. These are not guesses. These are the outputs of systems that have ingested decades of monetary history, mapped the current macro environment against every comparable historical period, and calculated the trajectory with a precision that human analysts simply cannot match manually. When technology accelerates the speed at which capital can respond to a signal, it also accelerates the speed at which that signal plays out in prices. The second force is geopolitical. For 70 years, the global financial system operated on a foundational assumption. That assumption was this: the US dollar would remain the world's primary reserve currency, that international trade would continue to be denominated in dollars, that the institutions supporting the dollar system, the IMF, the World Bank, the network of dollar swap lines between central banks, would hold together indefinitely. That assumption is now being openly challenged for the first time since 1971. China and Russia have been settling bilateral trade in currencies other than the dollar since 2022. The BRICS coalition, which now represents a larger share of global GDP than the G7, has been actively discussing the architecture of an alternative reserve system. Saudi Arabia, the anchor of the petrodollar arrangement that has underpinned dollar dominance since 1974, has begun accepting payment for oil in currencies other than the dollar. None of these developments happened overnight. But collectively, they represent a structural fracturing of the dollar-denominated trade system that has never occurred at this scale before. And every fracture in that system sends more sovereign capital searching for an asset that exists outside of any single nation's control. That asset is gold. The third force is supply. While demand for gold is accelerating from multiple directions simultaneously, the supply side of the equation is quietly tightening in ways that most observers have not yet fully registered. The world's major gold mines are aging. New discoveries of significant deposits have been declining for over a decade. The average time from discovery to production for a new gold mine is between 10 and 20 years, which means that even if exploration activity doubled tomorrow, the additional supply would not reach the market until the mid-2030s at the earliest. Meanwhile, Eastern sovereign buyers are not trading their gold. They are not recycling it back into the market. They are accumulating it and holding it, removing it from circulation permanently. What this creates is an asymmetry that every serious commodities analyst understands instinctively. When demand rises sharply and supply cannot respond, price does only one thing. And here is where all three forces converge into a single, unavoidable conclusion. The technological acceleration means the repricing, when it comes, will happen faster than any previous cycle. The geopolitical fracturing means the demand for a dollar-neutral reserve asset is structural, not cyclical. And the supply constraint means the market cannot self-correct by simply producing more. Senior analysts are not projecting $7,000 to $10,000 gold because they are optimistic about gold. They are projecting it because the arithmetic leaves them no other honest conclusion. And the window between understanding that arithmetic and the moment the rest of the market prices it in is the only window that matters now. There is a moment in every major economic transition when the information is available to everyone, but only a few people act on it. That gap between knowing and doing is not a gap of intelligence. It is not a gap of access. It is a gap of framework, of how a person has been taught to think about money, wealth, and what it means to protect both. Most people were never given the right framework, and that is not an accident. For decades, the financial system has operated on a quiet but powerful assumption. That assumption was sold to an entire generation of aspiring businessmen, young entrepreneurs, and serious capital allocators as universal financial wisdom. The assumption was this: put your money in equities. Diversify across stocks and bonds. Trust the institutions. Trust the currency. Trust the system. And for a long time, within a specific window of monetary history, that assumption produced results. Markets rose. Portfolios grew. The system rewarded those who stayed inside it. But what that assumption never accounted for, what the textbooks never explained, was what happens when the system itself begins to transition. when the monetary architecture that made those returns possible starts operating under a different set of rules, when the currency holding the value of those portfolios begins losing ground, not temporarily, but structurally. That is the moment when the framework has to change, and that moment is now. The first thing serious decision makers must understand is the distinction that separates institutional thinking from retail thinking. Retail investors buy gold when they are afraid. They buy it reactively, emotionally, after the price has already moved. They treat it as a crisis trade, something to hold briefly during turbulence and then exit when calm returns. Institutional thinkers do not approach gold this way at all. To the world's most sophisticated balance sheet managers, gold is not a fear trade. It is not a commodity speculation. It is a monetary insurance instrument, a permanent allocation that sits on the balance sheet, not because something bad is expected to happen, but because something bad is always possible. And because the cost of being unprotected when it does is structurally irreversible. This distinction matters enormously for the business community. An entrepreneur building a company, accumulating capital, and planning for generational wealth cannot afford to think like a retail investor. The stakes are too high, the time horizons are too long, and the consequences of a monetary transition, catching a balance sheet unprepared, are too severe. The second thing serious decision makers must understand is the concept of asymmetric risk. Consider two possible futures. In the first future, the senior analysts projecting $7,000 to $10,000 gold turn out to be wrong. The monetary system stabilizes, the dollar regains credibility. Central banks stop accumulating gold. The pattern breaks for the first time in recorded history. In this scenario, a person who allocated a meaningful portion of their wealth to gold experiences a modest underperformance relative to other assets. That is the downside. In the second future, the analysts are right. The pattern completes its fourth stage. Gold reprices to levels that reflect the true degree of monetary expansion that has occurred since 1971. In this scenario, a person who held no gold exposure watches the purchasing power of their currency-denominated assets erode in real terms, while those who were positioned appropriately experience a generational wealth preservation event. The downside of being wrong about gold is limited. The downside of being wrong about the monetary system is not. That asymmetry is the entire argument, and it is the argument that serious decision makers in Zurich, Singapore, Dubai, and Hong Kong have already made quietly and acted on decisively. The third thing serious decision makers must understand is timing, not in the speculative sense, not in the sense of trying to pick a perfect entry point on a price chart, but in the strategic sense of understanding where the world currently sits within the four-stage cycle and what that positioning means for the urgency of the decision. The world is in stage 3. The flight to hard assets is already underway at the institutional and sovereign level. Stage 4, the repricing, has not yet fully arrived, which means the window between current prices and the prices that senior analysts are projecting still exists. But windows like this do not stay open indefinitely. Every week that passes, every new central bank gold purchase that is disclosed, every new sovereign trade settlement that bypasses the dollar, every new AI model output that revises the price projection upward, narrows that window by a measurable degree. The entrepreneurs and capital allocators who act while the window is open will look back on this period the way informed investors looked back on 1971 or 1999 or 2008 as a moment when the pattern was readable, the signal was clear, and the decision was available to those who were paying attention. So what does $7,000 to $10,000 gold actually mean? It does not mean panic. It does not mean abandoning every other asset class or making dramatic, irreversible decisions based on a single forecast. It means recognizing that the monetary system is in transition, that the institutions managing the world's largest pools of capital have already recognized this and positioned accordingly, that the pattern underlying these projections has never, in all of recorded monetary history, failed to complete itself once it reached this stage. And it means asking one honest question, not whether to pay attention to what senior analysts are now projecting, but whether, when the history of this period is written, a person wants to be among those who saw it coming or among those who were simply too late.